Hello everyone, welcome to Engineering and Economy. I'm Dr. Nathan. Today we are going to learn about internal rate of return. So it's called IRR. So in the last video we learned that about return on investment. So this ROI has a drawback that it doesn't consider the time value of money. So because that ROI do not consider the time value of money, we need to go for a better indicator, that is IRR, return on internal return on investment. So ROI, basically we had to compare with the last video. That's how we can develop the good understanding. ROI tells for entire project duration what is the return on investment. We got about 273% for entire investment for 25 years, but it doesn't tell what how long it's investment. But we know it is a 25 years investment, the solar PV lifespan. So internal rate of return will tell every year what is your return. You can take the answer and summarize. Every year you're going to get this much of return. So now we can go into the slides. So so as we said, so discount, how we find it. Now we are going to find this the IRR. So now we earlier, if you remember the net PV calculation, we used 3.4% for Australian discount rate, for Australia's discount rate. So IRR procedure is just you're going to use the opposite of uh, the NPV. So the PV calculation, present value equal to future value divided by 1 plus R to the power n. This is the equation. This R we use 0.034 because there is a 3.4 percentage. Now what we are going to do, the procedure, we are going to assign the NPV is 0 in the equation. So net NPV equal to present value of revenue minus present value of all the present value of investment, or net present value, because if you add more revenue we can tell net present value. So present value revenue. Now what is the procedure mean? We are going to make NPV is 0, and to get this 0 NPV, what is the R? What is the R? So it's reverse. It's a little bit of complicated in terms of mathematics, because we are going to add all 25 years revenue, first year revenue divided by 1 plus R to the power 1 plus second year revenue divided by 1 plus R to the power 2 plus third year likewise 2050 year end revenue likewise. And investment is simple because 50,000 is initial investment in our example. So if we have a maintenance cost and the any other cost, if you are going to include, that will come. So it's mathematically a little bit of complex, but what we can do in a like a simulation idea, like a trial and error. In the Excel sheet we can put some numbers, trial and error, and we will match closest to the. So idea is, this one is 50,000, we are very sure this is 50,000. So this entire term I want to be 50,000. So this entire term I want to make 50,000. This entire revenue I want to make 50,000. If I make 50,000, but if I want to make 50,000 the entire revenue, what R should be? What the R discount rate should be? If I put what discount rate, this entire revenue become 50,000. Just a simple question. So to make entire revenue or 25 years revenue to equal to 50,000, what is the discount rate I have to feed into this equation? I had to use into this. It's quite tricky and not to confuse with your previous videos. So we will go and check how we can do that. I had to share my screen and explain how we do that. So in this case, this is our Excel sheet, this 1 to 25 years. So this is your aging factor, this is your actual revenue, this is a net present value of the revenue. So we have the net present value of the revenue. Now the idea is this net present value of the revenue, this is the NPV of the revenue, all the revenue. So I want to make this NPV to 50,000 because my investment is 50,000. If I make all this NPV revenue to 50,000, then NPV becomes 0. So we took 3.2%, it becomes 0.032 for this value, because if you double click here you can find every equation we use this discount rate. So if we use the other values, then what will be the how it's changing. So if I use 6% instead of 3%, if I use 6%, 3.2%, if I use 6%, it become 96%, 96,800. But what is my target? Target is here to increase, reduce this to $50,000. I have to bring this to $50,000 because the $50,000 is my investment, so I have to equal. So I want to increase a little more. I mean, I'm increasing the discount rate by trial and error method. I make it 8% discount rate. Even for 8% discount rate, I'm not getting the 50,000. So I want to make it a 10% discount rate. So 0.1, 10% I mean 0.1. It's still I'm not getting, but it's come closer to the 50,000. So I go to jump directly to 15%. So if I go to 15%, it's lower than the 50,000, but very close. So it is not the 15. So it's something like 14.5%. It's still a little higher. So I reduce 14.5%. I make it 14.8 or 9%. Yeah. When I put 14.9%, I got 50,000, $20. $20 is extra, it's fine. So what is the idea here? With if the discount rate is 14.9%, then I will get this NPV 0 because this is 50,000, investment also 50,000, so revenue minus investment becomes 0. This is 50,020. So about 14.9% is my internal rate of return. Sorry for the spelling mistake. Discount rate. Yeah. So now we calculated the IRR, internal rate of return, for our investment. That is 14.9%. If you can create the Excel sheet, you can practice the same thing, and you will get the same answer. So 14.9%. What this means, like how we found, I just explain again. We make NPV 0. So NPV 0 mean NPV equal to total revenue minus total investment equal to 0. So my investment is $50,000. So what I eventually want to make, in order to make 0, I want to make this term to $50,000. How I can make? I can mathematically find, but it's quite complex because it's a 25 years um, present value. So 25 different terms it's adding. So what instead of doing, we can do the trial and error method, a simulation method. So in the Excel sheet, we change the discount rate. Originally it's 3.4% discount rate. This means 0.032 in the equation. So we increase to 0.06, they when increase to 0.08, likewise 0.1, then 0.15, then it's too much, then we reduced from 0.15 to 0.14. Okay, so we got 14.9% internal rate of return. This means like every year about 15%. If you approximate this become approximately 15%. So your IRR is 15%, take 15%. So every year your investment going to make 15% of return. So that's a very good amount of return you're getting. So again, it's a positive signal. You can invest on the solar panel project. This IRR is a very good indicator. It tells the it's considered duration as well. If you consider 20 years duration, your IRR is different. So internal rate of return is considered the duration as well. So two projects you can compare the IRR. Okay. So see, look at this discount rate equal to, so same thing. So it considered the time weighted return rate. Okay, go to the next slide. So now if you compare this ROI, return on investment, with IRR, IRR is telling the uh, return on investment, telling the growth of the project from the start to the end of the project, start to end. But IRR tells annual growth rate, annual return rate. Annually you're getting 15%. So it's more than what banks offering, the fixed deposit offering. So it's better. So this investment is better. You can compare with other businesses, whether any other business is giving 15% return. If not, then this business is a good business. This is how we are making decision. That's all for today. Please subscribe this channel and give your full support so that I can upload more such videos. Thank you for now. We'll see you in the next video.